And now for something completely different.
It's a rich man's world.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning, welcome to the show. Of course, it's Monday as
Money must be funny in a rich man's world. Money, always Sunday in a rich man's world.
What's important here is that as we kind of continue to see this market work through the situation that we've been in, of course, there's lots of headlines out right now, and that tends to get a bit confusing as to what's actually driving markets. And we've been talking about this over the last couple of weeks. Of course, the most recent headlines, of course, are the Omicron variant. I'll spit that out this morning. It's Monday. Give me a break. But that's the headline right now. And it's like, oh my gosh, the market's selling off because of this new variant. Yeah, but, that's a little bit of it. But the market's priced these things in fairly quickly. And what we already know about the virus's period is that they've got a very high survival rate. If you're vaccinated, it's 99.9%. If you're not vaccinated, it's 99.975%. So it's incredibly high survival rates for these viruses, and the market knows this. They've already priced this in for the most part. So again, these headlines are one thing, but what's actually driving the markets underneath that are different things. And again, if you take a look at what's actually happening internally in the markets, we're watching a lot of these previous meme stocks that have been running up earlier this year. The most shorted names, a lot of these AMC's, GameStops, and other types of stocks, those have not really been working lately. And there's a reason, because this is some of those areas that are getting sold off by mutual funds to make these distributions. And we've talked about this previously, is that the first 2 weeks of December tend to be fairly sloppy because of mutual fund distribution. That applies additional selling pressure to the markets. And going into this, we've had this very nice rally in the markets in October and early November, and the markets kind of stalled in November, and we talked about our money flow sell signals, and we had gotten those in place. And of course, now we've got a much more important sell signal with moving average indicator now triggered, and that's been that case for a couple of weeks, and that's really been supporting the sell-off here. And again, this is all part of those mutual fund distributions. They have to sell. Now, think about what happened with mutual funds this year in particular, right? They have a lot of positions on their books. They've got huge gains in tech stocks in particular. And what are the names right now getting sold off the most, right? It's tech stocks. It's NVIDIA and AMD and these other stocks that have huge gains this year. So as a mutual fund manager, I've got position weights in my portfolios, and I've got a lot of positions that are very overweight. They're, what they're supposed to be relative to the portfolio. So those are getting sold off, and money's being put into, and we saw this on Friday. Value stocks have been performing over the last couple of days because those are the ones that haven't worked this year. So all those positions are really underweight in these portfolios. So mutual fund managers are selling the ones, the big gainers, and they're buying some of the laggards in their portfolio that have been, they need to bring the weights up in. It's about balancing and weighting in the mutual fund portfolios. So that's kind of what's going on here. Now, we're getting close to the end of that. We've got about another week of sloppiness to go here, but the markets are holding on to really important support here over the last couple of days. That's very encouraging. Markets are now very oversold on various levels. And really, whether you just look at relative strength or momentum, they're all getting very oversold by those perspectives. But also take a look at sentiment. You take a look at the CNN Fear Greed Index. It's back down to lows in terms of people being very fearful about the markets, right? There's a lot of fear in the markets right now. Not surprising after you've had this little sell-off. Of course, take a look at the bearish sentiment, the American Association of Individual Investors. Their bearish sentiment is now back down to lower levels. And of course, from a contrarian standpoint, what you're looking for is that when the market was running up here, we were talking about the record number of call options. Nobody wanted to buy a put option to actually hedge risk in their portfolios. Well, now that we've had this decline in the markets, now there's this huge demand for put options. Now, again, the great thing about options traders is they typically are always on the wrong side of the markets. And this is why, historically, if you look at people who trade options, they don't last for very long because they wind up blowing themselves up because they typically get on the wrong side of the market. Most of the time, a very large percentage of the time, options expire worthless. So people lose a lot of money in the options market. But that's what you've got now is a very high level of put options at this point, suggesting that people are very bearish on the market. They're all betting the market's going to go lower. And those are typically all good setups for at least a short-term rally. And that's kind of the important thing here. Now, look, don't confuse when you're talking about a short-term rally versus a longer-term bull market. Those two things are very, very different in nature. But, as with anything, when you get a lot of exuberance in the markets, you're typically going to get a pullback. And then when you do get that pullback and get a lot of negativity, you typically get a little bit of a counter trend rally. And that's all we're talking about here as we get ready to move into the end of the year. All we're suggesting is don't get overly cautious right now because a lot of the selling in the market has already been done. A lot of this stuff about the variant and virus and all this, it's already been priced into stock. So don't overreact, to where we are in the markets. We are still clearly on a sell signal here, which is important. And so we don't want to discount that sell signal, and we don't want to discount the fact that there's still pressure on the markets. But the markets have been in a very, very defined downtrend at this point, and again, holding support here. This is all very important for the markets. And so again, at least a bounce over the next couple of days will be likely. And when you get that bounce, this is really kind of the way you want to trade this. Is that if you have, I'm getting a lot of emails right now. One thing we're going to talk about in the next segment of the show is how to hedge risk, because that was one of the emails I got over the weekend. It's like, okay, what do I do now? I need to hedge risk. Well, there's multiple ways to do that. We'll discuss that a bit more. But if you haven't liked the sell-off, it means you have too much risk in your portfolio. So use this rally to clean up some of those areas that are really hurting you the most. And again, I can almost suspect most people that I'm getting emails from right now, if I looked at their portfolios, I'm going to see all the high flyer names. I'm going to see the stocks that have been performing the most this year. And of course, most of those are stocks with very, very poor fundamental quality. And the one thing that we have to remember here, and something that we'll talk about a lot more over the coming couple of weeks, is this sell-off in the market really has very little to do with the Omicron variant. It has much more to do with what's happening with the yield curve, which is continuing to flatten because the economy is going to be slowing down next year. Liquidity is slowing down, and now the Fed is talking about hiking rates and reducing monetary input into the economy, and into the market. So again, it's that tightening of monetary policy really that the markets are beginning, and we're in the early stages of countering for. And that's really what's moving a lot of this. So yes, a lot of this sell-off here recently is mutual fund distributions, but there's also a very realistic change to the mentality of the markets that's going to be coming over the course of the next few months, that we've got, the markets are going to start preparing for a change in the monetary regime by the Federal Reserve. Now, this is going to be one of the big questions. This is going to be the big debates that we're going to have coming up over the course of the next few months. Is there really inflation? And is that inflation more permanent than it is transitory? And is the economy going to continue to remain strong in this? Are we going to continue to have this very tight supply chain structure, or is that going to start to ease up as well? We're already starting to see some early signs that the supply chain disruption is beginning to ease. So again, we may find out that the Fed is now beginning to tighten monetary policy on the expectation of higher inflation just at the time that inflation begins to become more deflationary in nature. Be right back after the break. How to hedge your portfolio risk. You're listening to The Real Investment Show. I'm your host, Lance Roberts.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Retirement's not what it used to be, and long-term care could enhance your golden years. The question is not whether you can afford it, but whether you can afford not to have it. Our next virtual Lunch and Learn will cover the management of long-term care expenses that could make or break your retirement. Join Jonathan Penn and Chris Liebum for the basics of long-term care. Register at realinvestmentadvice.com for our virtual Lunch and Learn on long-term care. December 9th at noon. realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately, for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, simply online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. I'm your host, Lance Roberts. Of course, you're listening to the Real Investment Show. So a couple of things, that happened over the weekend, of course, is we kind of look at where we are in terms of the markets and kind of where we're moving forward. And of course, lots of selling here over the last week or so in particular. And obviously, we've been through this numerous times this year. And it's amazing, really, psychologically, how fast people move from fear back to greed. And we've had several sell-offs this year. If you go back to February, March of this year, we had a big tech rout back in March, and people were, and we were down almost 5% at that point, and it was terrible, and the world was ending, and, Kathy Wood's arc was getting destroyed at that point, and, people couldn't figure out what was going on, and this was the end of the bull market. And then of course we rallied back, and as soon as the market started rallying back, everybody's like, "Oh yeah, we're it's all good. We're back to all-time highs, right?" And in about every month we get this correction back to the 50-day moving average, and we kind of go through the same, panic-driven headline rush that we get on the markets. Markets in turmoil all in the month of October. We had this market sell-off, and in September, we had this market sell-off. It was almost 5% down from the peak every day on CNBC. Markets in turmoil. So it's we go through this, and really this emotional gyration is driven a lot by what we see on the media. And, it's a constant battle with the media over, what's actually happening in the markets versus what they tell you. And this is something I was on Fox Business on Friday with Charles Payne. We were talking about this very same thing because, back in mid-November, we were right before Thanksgiving writing about, hey, mutual fund distributions are coming. This happens every year. And with a liquidity, structure in the markets that's very thin, it doesn't take a lot of selling to exacerbate some downside. And you had, back in November, we had people record long call options. We were writing about that in the newsletter. Yeah, lots of speculation and very extended markets and a lot of things. Stocks have been making big moves. We'd seen stocks moving very quickly to the upside. And of course, when there's no liquidity, and we've talked about this before, is that there's a few people willing to buy at current levels. And so sellers and buyers are kind of sort of matched at this point, and we're seeing that type of movement, right? Very light volume, and internal breadth really not very good. The number of stocks above their 50-day moving average, 200-day moving average is not healthy. We've talked about that narrowness of the breadth, that and the problem with that comes down to this liquidity issue. And the liquidity issue really shows itself when the markets are selling off, because that's where you see things like you saw on Friday with DocuSign down 40% a day. This is a good company. It was very overvalued, right? Speculators have been chasing into DocuSign because of this whole, work at home structure. We're all going to have to sign contracts on computers now, and because nobody's ever going to work in an office again. So stock had gotten really overvalued. And this lack of liquidity really showed up on Friday when the stock was down 40% in a day. Now, they had some disappointing guidance, but it wasn't worth a 50%, a 40% haircut to the valuation of the company. But that's that problem with liquidity, because there's no real buyers up here. The buyers are much lower. And so when there's a lot of people that want to sell, buyers are going, yeah, I'll buy it from you at this price. And you may not like it, but that's where you sell it. And this has to go with, and again, I said we talk a little bit about managing risk, because this was the email that I got over the weekend. It was like, well, how do I manage risk? How do I hedge risk? Well, hedging risk is not complicated. You just have to be willing to give up something to hedge. And see, this is the problem for most investors. And I get this all the time. People come in and go, oh, I'm super conservative, or I'm super aggressive, whatever it is. And then when the market does the opposite of what they think they are, then they want the opposite, right? So, if they come in and they say, oh, I'm really conservative, and the markets are running up 10 or 15%, it's like, well, we need to, why am I not beating the index, right? Well, because you said you were conservative, your allocation is set up that way. Or I'm super aggressive, and now you're down 5 or 10%. You're going, why am I losing so much money? Well, because the market's going down and you're super aggressive. So psychology is important. And you got to understand that if you're going to hedge for risk, that means you've got to lower your expectation for return somewhat. And think about it this way. You have two choices. When you're driving your car, you can drive your car with a brake or without a brake. Now, you can drive your car without a brake, right? I can take the brakes out of your car, send you off to work. You may get there. But as long as you're on the freeway, you're fine, right? Because everybody's moving the same direction, and as long as nobody screws up somewhere in front of you, you really don't need a brake, right? You just flow right along with traffic. It's all fine. The problem comes is that when you need the brake, right? And you don't have one. And this is the same thing with a portfolio. If you want to get the maximum return out of your portfolio, you want to track a benchmark index. You have to do that without a brake. And as a consequence of that, you are going to have to suffer the ebbs and the flows of the market. If you want to beat the index, you've got to take on more risk than the index. Which means now your accelerator is tied to the floor and you have no brake. So you have to take on a lot more risk. Now, again, it may be fine for a while. The problem becomes when something goes wrong. So part of investing is figuring out what it is that you're trying to achieve and figuring out a way to get to your goal without completely crashing yourself along the way. And this is what we forget. My goal is to make 5, 6, 7% a year, whatever that number is. We call it in our shop, we call it a hurdle rate. So when we do your financial plan, and Danny and Richard and John Penn do a great job of this, but they go through the financial plan with you and they say, okay, look, in order to meet this goal, you want to have X dollars in the bank at retirement, you're going to need this much money.
And to get there, based on what you have today, we need to make about 4% a year, 5% a year, whatever that number is. That's your hurdle rate. And if you hit that number every year, you're going to get to your goal. Now, does that mean that once you get to 4 or 5% that you just cash in all your chips for the year and go home? You could do that, right? But, the goal is saying, look, we want to make sure that we control risk so that we don't lose 30 or 40% of your money and then have to make that up. Plus, and this is what everybody forgets, right? The whole buy and hold analysis, that people preach on television, they forget to tell you this one very important fact. They go, yeah. Well, if we were buying and holding, you're going to make money long term. And sure, there's going to be periods of time where you lose money, but markets always come back. Well, here's the one little aspect they forget to tell you about buy and hold investing. If I'm supposed to make 5 or 6% a year and I lose 50% of your money, right? Now, eventually the markets are going to come back. So you're going to make your 50 or 60% of your money back. So let's say, hey, let's go back, talk 2008, right? 2008, market crashes, you lose 50% of your money. And the markets got back to even in 2017 to where we were back in 2015. 2008. So it took this whole long period of time to get back to even. So that's fine, right? So you get back to even. But they forget to tell you about the 5, 6, 7, 8 years between the previous peak and and getting back to even that you still have to make up for because you needed 5 or 6 or 7% a year, whatever your number was, for all those years. So if you had 5% a year compounded, and this is the other big myth of the markets, is that markets compound. They don't. But now you've got to make up that 50% loss plus all the years that you didn't make a 5, 6, 7% rate of return. And that's why most people don't reach their financial goals. If investing was as easy as everybody says it was, then why is it that, hardly anybody, 80% of Americans have less than $500 in the bank and less than 1 year's salary saved up? Investing's not easy because of these very issues. Seems easy at times, but it's not. So hedging risk and understanding that you can hedge risk, but you have to give up something for that hedge. It's not a free thing. But hedging risk is a very simple process. And there's some very simple ways to do that. But before you start going in and saying, I'm going to hedge the risk in my portfolio, you've got to understand what that means. And that means that you are applying a brake to your portfolio. It will lower your returns. You cannot have a lower risk portfolio and match the benchmark index. Just doesn't work that way. And guess what? There's nothing wrong with that. If you protect the downside risk of your portfolio, in other words, when the markets are down 15 or 20 or 30% and you're down 3, 4, 5%, you getting yourself back to even and begin to accrue value towards your retirement goals happens much quicker than those trying to play catch up from a major market decline. So I said we talk about hedging risk. So now we understand that hedging risk requires giving up something. We'll talk about how to actually hedge risk and some opportunities when we come back from the break. I'm Real Science Roberts on The Real Investment Show. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Retirement's not what it used to be, and long-term care could enhance your golden years. The question is not whether you can afford it, but whether you can afford not to have it. Our next virtual Lunch and Learn will cover the management of long-term care expenses that could make or break your retirement. Join Jonathan Penn and Chris Liebum for the basics of long-term care. Register at realinvestmentadvice.com for our virtual Lunch and Learn on long-term care. December 9th at noon. realinvestmentadvice.com.
Have the market's gyrations made you nervous? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. We do that by having both a buy and sell discipline. Does your advisor do that? If you think it's time to work with an advisor who puts your interests first, it's time for real investment advice. RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I went to see the doctor. Really great guy, but he's an older guy, kind of like Coach Murphy that you grew up with in high school. And it never cost me more than $25 to go see him because his solution is pretty much the same every time. Rub some dirt on it and walk it off. And I said, well, don't you have something you maybe give me for the pain? He hands me a thing of Tic Tacs. He says, take one a day and pretend it doesn't hurt. What's your problem?
The Real Investment Show podcast. Same show, your schedule.
And it works just fine.
At realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows. Subscribe and bookmark our YouTube channel for The Real Investment Show. Or just click on the show links at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So I was just listening to that commercial about Coach Murphy, my doctor. So if you don't know the story, I tore my knee up running, and I went to see my doctor, who's an orthopedic surgeon, and went in and saw him. And I call him Coach Murphy because his remedy is always rub some dirt on it and walk it off. And so I've been hobbling around here for, a couple of weeks, but I've been doing exactly what he told me, right? He gave me some stretches to do, and he gave me this box of Tic Tacs. He said, take this and you'll be fine. I'll be son of a gun. I'm completely fine.
The magic of Tic Tacs.
Exactly. But no, I mean, I did what he said, and so I'm back to normal, and I'm back to running. So
great.
Yeah. No, it's all good. I was just like,
problem solved.
But no, it's all good though. I definitely didn't want to have surgery, but he's this crotchety old guy. You gotta love it. Anyway, so before the break, talking a little bit about hedging. So the point I want you to understand, and this is the mistake that people make, is that
hedging risk requires you to give up something. And people think they want to hedge. People always think they want to hedge risk when markets are going down. Then as soon as the market's going up, they go, well, I don't want to hedge, right? The markets are going up. That's not how hedging risk works. And that's not how portfolio management works. But you've got to pick your poison, right? You either are going to suffer the slings and arrows of market declines when they occur if you're going to be aggressively allocated. The more aggressively allocated you are, the more that's going to hurt. Or you can learn to live with a little less and have much better returns long term. It just depends on what you want. But I said when we come back from the break that we talk a little bit about how to actually hedge risk. See, and that's the important question. How do you do it? Right? There's tons of ways to hedge risk. The easiest way, I know this is a complicated one, so just if you're driving, I suggest you pull over and pull out a notepad because I'm going to really get into this for you. Sell something. Raise a little cash. If you have less money, so if your portfolio is 100% equities and you're tracking the S&P 500, if you want to hedge risk, in other words, you want to lower how much you're going to lose when the markets go down, sell something. I know it's complicated, right? Another way to do that. Okay, well, let's back up real quick too. Let me say something about selling something because people always take this wrong. We regularly write, so if you haven't subscribed to our newsletter, I really suggest you're missing something in your weekly analysis because we go through every weekend kind of what's going on in the markets. We talk about risk management. We also tell you exactly what we're doing in our portfolios. And we write often about, hey, we're taking profits in this, we're reducing sizing in this, we're adding money to this, those type of things. And when people say, or when people read that we are taking profits, they assume we're selling everything in our portfolio and going to cash. That is not what we're saying. And I'm not suggesting that's what you should do. But, if you have a stock that's, let's say that, one of the basic rules of portfolio risk management is sizing your positions. And any great trader will tell you about the importance of sizing your positions. It's essentially the same thing as when you're betting on a hand of poker. How much do you bet? It depends on the strength of your hand. So size your positions. If you're taking a lot of risk with a position of fundamentally poor stock, as an example, have a smaller position in your portfolio. So if your normal position size in your portfolio is, let's say you structure your portfolio that you're going to have 60% of your portfolio in stocks, so you're going to have 12 positions to manage, so you have 5% in each position, right? Something like that. So you got 12 stocks you've got to manage, you've got 60% exposure, 100% exposure, whatever it is. You have a maximum position size for each position in your portfolio. So let's say your normal position size is 5, but you're going to take a flyer on a really risky stock, so your maximum position size is 2 in that one. But see, we get greedy. And we go, yeah, but this stock's really going up, so I'm going to put a whole lot more money into it. And it's great until you wind up with a DocuSign that loses 40% in a single day. And that's not uncommon. In this market, particularly, that is not uncommon. So size your risk. That's a way to hedge risk. So if that 2% flyer in DocuSigns becomes 3 or 4% of your portfolio because it's gone up so much, reduce it back to 2%. Take your profits. Old saying is nobody ever went broke taking profits. But that way, when the stock makes a 40% plunge, you're playing with house money, not your money. So sell something. Reduce the amount of risk. When the S&P gets very extended above its long-term means, and we start talking about, on the show about, hey, markets are very overbought here, be a little bit cautious, raise a little bit of cash. Raise a little bit of cash is code word for sell something. It's not complicated. All right, another way to hedge. Buy something that goes up when the market goes down. What could that be? How about bonds? Got a chart of a 10-year Treasury. If you're driving, don't worry about it. It's okay. I'll explain it. Bonds have been going up while the market's been going down. Not surprising. This is simply a function of risk on, risk off psychology for the markets. When markets are under selling pressure, money's got to go somewhere, because as a portfolio manager, I've got to be allocated, because if I don't have your money allocated, and this goes for mutual funds, hedge funds, private equity funds, etc., I can't charge you a fee for sitting on cash. So as a portfolio manager, when markets are going down, I've got to put that money somewhere. So if I'm, raising profits, taking profits out of some area of my portfolio, money tends to go somewhere else. So it's a risk off, risk on mindset. And with bonds here lately, bonds have had a great run as the markets have been selling off. So now we're talking about potentially a short-term rally in the markets. And that's because, look, take a look at bonds right now. They're more than 2 standard deviations above their 50-day moving average. That is very outside the norm. And historically, when that occurs, you're going to get a pullback in bond prices. In other words, yields go up a bit as bond prices pull back, because money's coming from risk off, being safety, back into risk on, being stocks, and so you get a short-term rally. Don't be surprised if we don't see that in the next couple of weeks. That setup in bonds right now suggests that bonds are very overbought, so if you've been long bonds, then you may want to take a little bit of money off the table. And that's okay. Bonds work just like stocks. They go up and down in price. So take a little money off bonds, put in cash for the moment. If you're not sure what to do with your cash, it's okay to hold cash. That's item 3 to hedge your portfolio. Cash is a risk-free hedge. It doesn't go up or down in value. I can hold money in cash and I can figure out what to do next. I can wait for an opportunity to do something, whether it's to buy bonds or Bitcoin or whatever it is I want to buy. I can wait for the right opportunity. And this is important, right? Because that is the whole value of investing. See, that we've also come, the media has driven us to think that we have to be invested all the time or we're missing out. Let me ask you a question. If houses were the only investment vehicle on the planet, would you go buy a house every day because you've got cash? No, of course not. But that's what we think about with stocks. Let's go back to poker. We use poker as a good analogy to the stock market. It's the same thing. It's the purest form of speculation. When you're betting on a poker hand, do you bet all in every hand? No, of course not. So whoever said you had to be invested in the markets at all times, always? You don't. There's nothing wrong with sitting on some cash, waiting for the right opportunity to come along to buy something that is A, good value, and B, a real opportunity. That's the whole premise of investing to start with. Okay. Now, we can get more complicated with hedging. There's options. You can buy put options to hedge downside risk in your portfolio. You can write call options to lock in gains in a particular stock, raise a little bit of premium. There's a lot of things. I'm not going to get into a big, long options conversation this morning because it does get very kind of convoluted because there's so many variations of strategies you can use with options. But if you understand options and understand how to use them, using put options is a way to hedge your portfolio. You can buy out of the money puts on the S&P to hedge your equity longs in your portfolio. And we have a portfolio structure we call a platinum model that we use for high net worth investors. Exactly what we do. We buy long dated out of the money put options to hedge our portfolio risk against a decline just like this. So those things can help. But the important thing here is hedging risk is not complicated. And it sounds like hedging risk, it sounds like it's complicated. It's not. It really comes down to 2 words. Sell something. That's hedging risk. Raising some cash, taking some profits, repositioning your portfolio, rebalancing your portfolio. Look, if you've got a lot of stuff that's had huge gains, move them back to your original weights. If you've got stuff that has not been performing, maybe you want to think about getting rid of those things. Losing money in positions is risk also, because it's dragging down the performance of your whole portfolio. So, if you need help, go by the website, realinvestmentadvice.com. Send us an email. Happy to help you out with your portfolio and helping you figure out how to hedge risk if you need it. realinvestmentadvice.com. We'll be right back to wrap up the show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Retirement's not what it used to be, and long-term care could enhance your golden years. The question is not whether you can afford it, but whether you can afford not to have it. Our next virtual Lunch and Learn will cover the management of long-term care expenses that could make or break your retirement. Join Jonathan Penn and Chris Liebum for the basics of long-term care. Register at realinvestmentadvice.com for our virtual Lunch and Learn on long-term care, December 9th at noon. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show. I'm your host, Lance Roberts. Of course, we're getting ready to wrap up the year. Of course, this always brings up lots of issues for people and for markets and for kind of the outlook for 2022. And we're getting a lot of these outlooks for 2022 right now. You know, every major Wall Street firm's coming out. Next year is going to be, S&P will be up another 9% next year, be up 10%, whatever. They're always bullish, right? They're, you know, majority of the time when you see Wall Street analyst expectations for the next year, they're always positive. I've never seen a year where 10 analysts came out and said, "Oh, next year the market's going to lose money." It never happens. The reason is they have to sell you product. So telling you to be all in cash as we go into next year is not good for them because, again, they don't make any money with you being in cash. And if you're not buying the IPOs and SPACs and things that they're issuing, and we've had a record issuance of that stuff this year, they're not making money. So be careful with outlooks. I've talked about this before, is that back in the late 90s, there was this study of meteorologists and psychics and tarot card readers and and Wall Street analysts, everybody that made predictions about anything. And they measured the accuracy of these predictions over a period of time, and it turns out that the most accurate predictions came from meteorologists. And of course, you know, people complain about meteorologists all the time because there's no rain in the forecast and it rains, right? It's a 20% chance of rain and it rains, right? The point is that the accuracy of meteorologists is good for about 3 days. Outside of that, it becomes essentially the same as a coin flip. And this goes and of course, you know, once you get out further in time and really kind of go through other predictors, it gets far worse. But the point is that after about 3 days of predictions, things get very fuzzy. And again, a coin flip will pretty much tell you what will happen by the end of the year at this point. Now, we can go back and look at statistics, seasonal tendencies. We can look at all these things. But regardless of all that analysis, it's still a guess. We're guessing what's going to happen in this year. And look, whatever happens in the headline that causes algorithms to start to sell the market, who knows? We've got lots of Greek letters of the alphabet left to go through with variants of the virus. Is that what's really driving the market, or is there something else happening? That's the thing you need to know about. But sentiment, at this point is very negative. So statistically and seasonally, we should theoretically expect a rally heading into the end of the year. But getting into next year, and again, as you start talking about 2022, all these analysts are expecting very lucrative returns for 2022, and they're always bullish. Because bullish bias is what sells, as I said, is what sells products. But betting on those type of things is very risky for your money. Because again, accuracy of predictions, about 3 days. Outside of that, it's a coin flip. Going into next year, we got a lot of things. We got a lot of headwinds. You got the Fed talking about tightening monetary policy. You've got potential hikes of interest rates. You've got slower economic growth coming. You've got less liquidity coming in from the markets and from federal governments, central banks around the world. All those things are headwinds. Earnings will slow. And those are all going to potentially weigh on asset prices. So could the markets be positive again next year? Absolutely. It's about a 50-50 shot. There's about a 50-50 chance they won't. So I really would take a lot of these predictions as a grain of salt because they don't know. I don't know. We could make some guess about next year's outcomes. But, man, a lot of things have to go right. I mean, when you're talking about valuations at 40 times earnings, you're talking about earnings beginning to slow and profit margins beginning to get squeezed because of higher inflationary pressures, tightening of monetary policy. None of those things are really great for stock market returns. Now, does that mean you should all, all be in cash? No. I don't want you emailing me or somebody else emailing me and saying, oh, I heard you said we should be all in cash. That's not what I'm saying. What I'm saying is that there is a lot of things that have to go right next year in order to keep the markets this elevated. One of the major things that have been driving the markets have been stock buybacks. Stock buybacks have made up 40% of the advance since 2011. 40%. So if you stripped out stock buybacks, the market wouldn't be trading at 45, 46, 4,700. It'd be like 2,500. Be about a 3% annualized rate of return, exactly what you would expect from valuations where they were when we started back in 2011. Not nearly as exciting, is it? But that's how much stock buybacks have contributed to the rally. So you're really depending on a lot of actions happening next year that happened this year. We've had $1 trillion worth of global liquidity inflows into the U.S. market over the last year. This is one of the big drivers of asset prices. That's got to continue again next year. Problem is that $1 trillion is about 3 times the rate of global inflows that we've ever had in history. I mean, it's well outside the norm. Going back and talking about corporate buybacks. Corporate buybacks are fine as long as they've got lots of excess liquidity, but if things begin to slow down next year and corporations become more concerned about, maintaining profitability and maintaining their balance sheet cashes, cash levels, et cetera, they may pull back on their stock buybacks. And there's no guarantee of that, but there's a risk. So this is what I'm saying is that, these predictions are all kind of hinged upon everything being exactly the same next year as it was this year. And that's going to be a bit of a stretch. So again, I wouldn't, this isn't something where you go and say, oh, I got to be all in cash and, there's this terrible stuff. I'm not saying that at all. But what I am saying is that you need to at least be aware that all these very bullish predictions for next year are no more valid than a coin flip. And, if you go back to 2007, as an example, predictions for 2008 were exceedingly bullish. Go back to 1999, predictions for 2000 were exceedingly bullish. 2001, predictions for the next year were bullish. 2002, the predictions for the next year were bullish. You should buy. More often than not, markets are positive than negative. Bear markets are very fast when they occur. Bull markets are slower to advance. So you have more you have more bullish years than you have bearish years. The problem is that when the bearish years occur, they wipe out years of the previous bullish advances. And it can really set you back financially. So the whole point about this is be careful with predictions. Nobody knows. All we can do is navigate the markets that we're in. It's kind of like a ship captain, right? You're looking on the horizon. It's clear sailing, calm seas. Everything's fine, right? Then all of a sudden, an iceberg. That's what happens in the markets. These squalls come up from nowhere. We don't, we're not seeing them. They're, you listen to the media, everything's fine. The markets are rallying. It's awesome. And then all of a sudden you get this squall just shows up out of nowhere. Catches you off guard. And that's when we talk about hedging risk. When things are too good, when things are going so well in the markets, have a regular process of taking some profits off the table. Selling your laggards and losers. Things, if the markets are going up and you've got positions in your portfolio that aren't, there's a reason. Sell them. The worst thing you can do for your portfolio long term is go, well, as soon as it comes back, but I really like this company and I'm sure at some point down the road it'll do fine. Those things will get you in trouble more often than not. Those are emotions. Those are things where you're making rationalizations for why you made a bad decision, and you're going to wind up making a worse decision for trying to rationalize it. Sell them. Move on. You can always buy it back later when it starts to work. Happens all the time. Moving into the year, this is a great time. Those laggards and losers, you probably got some nice gains this year and stuff. Take some gains, sell your laggards and losers, offset your gains with your losses, reduce your tax consequences, clean up your portfolio. This is a great time of the year to start cleaning up your portfolio, getting ready for 2022, whatever it brings. Good, bad, indifferent, doesn't matter. Be ready for it. But this is a good time to start cleaning up the portfolio and getting it ready for next year. I'm Real Sense Roberts. Get by the website, realinvestmentadvice.com. Send us your questions, comments, emails. Let us know what we can do for you, of course. As always, latest blog posts are out as well on the site. We've got a lot of stuff coming up this week as well. And make sure you subscribe to our daily commentary and our weekly newsletter. We'll keep you up to date on everything that we're doing with our portfolios, with your money, all at the website, realinvestmentadvice.com. See you tomorrow.